There's a specific portfolio size that separates the top 3% of dividend investors from everyone else. It's not what you think, and most people have no idea they're falling short. Today, I'm revealing this exact number, why 97% never reach it, and the three critical mistakes that keep investors stuck in the bottom tier. If you've been building your dividend portfolio for more than 2 years, this video will either validate you're on track or show you exactly what needs to change. Meet Sarah. She started dividend investing 3 years ago with $15,000. She's been consistent, adding $500 every month, buying solid dividend stocks like Coca-Cola, Johnson & Johnson, and Realty Income. She feels good about her progress. Her portfolio is now worth $42,000, and she's earning about $1,200 annually in dividends. Sarah thinks she's doing everything right. She's not. Sarah represents the typical dividend investor, methodical, disciplined, proud of her monthly contributions, but she's trapped in what I call the accumulation illusion, the false belief that steady growth equals financial freedom. The harsh reality? At her current pace, Sarah will never reach financial independence through dividends. Neither will 97% of dividend investors. The magic number that separates the successful 3% from everyone else isn't just about portfolio size. It's about understanding what that size actually means for your financial future. If you want to discover whether you're in that elite 3% or stuck with this majority, subscribe right now. I publish new videos every Tuesday and Friday that break down exactly how to reach true dividend independence. And today's revelation will either confirm you're on the right path or completely change your strategy. But here's what's going to surprise you most about this magic number. It has nothing to do with the arbitrary six-figure milestones most investors obsess over. The real benchmark is based on a mathematical principle that most dividend educators never mention. And once you understand it, you'll see why 97% of investors are essentially spinning their wheels. Let's start with what everyone gets wrong. Most dividend investors focus on portfolio value milestones like $50,000, $100,000, or $500,000. These numbers feel significant, but they're meaningless without context. The real question isn't how much you have, it's how much your portfolio generates relative to your living expenses. The magic number is this. You need a dividend portfolio that generates 75% of your annual expenses. Not 100%, 75%. This is the threshold where dividend investing transforms from a side hustle into a legitimate path to financial freedom. Here's why this specific percentage matters. When your dividend income covers 75% of your expenses, you've reached what I call the flexibility threshold. You're no longer dependent on your primary income for survival. You can take calculated risks, negotiate from a position of strength, or even step away from traditional employment without financial panic. More importantly, you're close enough to full dividend independence that the remaining 25% becomes achievable through modest lifestyle adjustments or part-time income. Let's put this in real numbers. If your annual expenses are $60,000, you need a dividend portfolio generating $45,000 annually. Assuming a 4% average dividend yield across your portfolio, that means you need $1,125,000 invested in dividend-paying assets. That's the magic number for someone with $60,000 annual expenses. But here's where most investors get lost. They hear $1 million and think it's impossible. They focus on the portfolio size instead of the income generation. Sarah, our example investor, makes this exact mistake. She celebrates her portfolio milestones without calculating what they mean for her actual financial freedom. Let's analyze Sarah's situation properly. Her $42,000 portfolio generates about $1,200 annually in dividends. Her annual expenses are $55,000. To reach the Taipei 75% threshold, she needs dividend income of $41,250. At 4% yield, that requires a portfolio of just over $1,030,000. Sarah is currently 4.1% of the way to true dividend independence. At her current contribution rate of $500 monthly, plus compound growth, she'll reach her target in approximately 32 years. She'll be retirement age before her dividend portfolio provides meaningful financial freedom. This is why 97% of dividend investors never reach the magic number. They're building wealth at the speed of traditional retirement planning, not at the pace required for financial independence. The successful 3% understands something different. They optimize for dividend growth rate, not just portfolio growth. Here's the first critical mistake that keeps investors in the bottom 97%: yield chasing without growth consideration. Many investors see a stock yielding 8% and think it's twice as good as a stock yielding 4%. This is mathematical illusion at its worst. Consider two investments. Stock A yields 8% today, but its dividend grows 2% annually. Stock B yields 4%, but its dividend grows 12% annually. After 10 years, Stock A generates about 9.8% of your original investment annually. Stock B generates 12.4%. The inferior yield becomes the superior income generator through the power of dividend growth. Real estate investment trusts provide a perfect example. Many REITs offer attractive current yields of 6 to 8%, but their dividend growth rates often lag behind inflation. Meanwhile, dividend aristocrats like Microsoft or Apple offer lower initial yields but demonstrate consistent double-digit dividend growth. The aristocrats almost always win the long-term income race. The second mistake is contribution inconsistency disguised as discipline. Investors like Sarah feel disciplined because they contribute regularly, but $500 monthly isn't discipline. It's mediocrity. The successful 3% understand that dividend independence requires aggressive accumulation phases, not comfortable monthly contributions. Consider this alternative approach. Instead of contributing $500 monthly for 30 years, what if Sarah contributed $1,000 monthly for 15 years? The math is identical: $180,000 in total contributions. But the compressed timeline allows compound growth to work more effectively. Her portfolio would reach the magic number 15 years earlier. But here's the twist most investors miss. Increasing contributions isn't just about contributing more money. It's about increasing your earning capacity specifically to fuel dividend portfolio growth. The successful 3% treat dividend investing like a business, not a hobby. They actively seek ways to generate additional income streams that flow directly into dividend stock purchases. This might mean freelancing, starting a side business, or optimizing their tax situation to retain more income for investing. They understand that their path to dividend independence is limited by their contribution capacity, not just their investment returns. The third critical mistake is sector concentration without strategic intention. Most dividend investors accidentally concentrate in utilities, REITs, and consumer staples because these sectors offer the highest yields. But yield concentration creates growth limitations that prevent reaching the magic number. Technology companies like Microsoft, Apple, and Broadcom offer lower initial yields but superior dividend growth potential. Healthcare companies like United Health and Johnson & Johnson provide defensive characteristics with solid growth profiles. Financial companies like JP Morgan Chase and Visa offer cyclical dividend growth tied to economic expansion. The successful 3% maintains sector diversification, not for risk management, though that's important, but for growth optimization. They understand that different sectors excel in different economic environments, and balanced exposure maximizes long-term dividend growth potential. Let me show you what strategic diversification looks like in practice. A well-constructed dividend portfolio might allocate 25% to technology for growth, 20% to healthcare for stability, 15% to financials for economic sensitivity, 15% to consumer staples for consistency, 10% to industrials for infrastructure exposure, 10% to REITs for income, and 5% to utilities for defense. This allocation optimizes for dividend growth while maintaining reasonable current income. It's designed to reach the magic number, not just generate current income. Now, here's what I've noticed after analyzing thousands of dividend portfolios. We've covered the mathematical requirements and common mistakes, but there's a psychological barrier that's even more dangerous than the technical errors. Most investors reach a comfort zone around the $100,000 to $200,000 portfolio range and unconsciously slow their progress. This is where 90% of the remaining dividend investors get eliminated from the successful 3%. They've built a portfolio that feels substantial, generates a few $1,000s annually in dividends, and creates the illusion of progress. But they're still decades away from true dividend independence. The psychological trap works like this. At $150,000, generating $6,000 annually in dividends, an investor feels wealthy. $6,000 covers their car payments, provides vacation money, or funds their hobbies. The dividends improve their lifestyle, creating satisfaction that reduces urgency. But $6,000 annually is only 10% of typical annual expenses. They're still 90% dependent on their primary income. The lifestyle improvement masks the fact that they're nowhere near financial freedom. The successful 3% maintain urgency throughout the accumulation phase. They treat their first $100,000 not as an achievement, but as proof of concept. They understand that the real wealth building happens between $200,000 and $1 million, and they optimize their entire financial life around accelerating through this critical range. This means aggressively managing their tax liability to maximize investment capacity. It means optimizing their living expenses not through extreme frugality, but through strategic spending that reduces long-term costs. It means treating every financial decision through the lens of dividend portfolio growth. For example, instead of upgrading to a more expensive apartment, they might purchase a duplex, live in one unit, and rent the other. The rental income flows directly into dividend stock purchases. Instead of financing a new car, they buy reliable used vehicles with cash, eliminating monthly payments that can be redirected to investments. These aren't extreme lifestyle sacrifices. They're strategic decisions that accelerate the path to dividend independence. The successful 3% understand that temporary optimization creates permanent financial freedom. Let's return to Sarah and model what strategic acceleration might look like. Remember, at her current pace, she reaches dividend independence in 32 years. But what if she implemented strategic changes? First, she analyzes her spending and identifies that she spends $400 monthly on dining out, subscriptions, and impulse purchases. By reducing this to $200 monthly, she increases her investment capacity by $200 without lifestyle degradation. Second, she develops a freelance consulting practice in her area of expertise, generating an additional $800 monthly. This isn't a second job. It's strategic income generation with the specific purpose of funding dividend investments. Third, she optimizes her portfolio for dividend growth instead of current yield. She transitions from high-yield, low-growth positions into dividend growth stocks with superior long-term potential. These changes increase her monthly investment capacity from $500 to $1,500, a 300% increase. Combined with growth-optimized stock selection, her timeline to dividend independence drops from 32 years to approximately 16 years. Sarah transforms from a typical investor trapped in the bottom 97% to someone on track for the successful 3%. The difference isn't intelligence, luck, or market timing. It's strategic intensity and growth optimization. But here's what's most important to understand about reaching the magic number. It's not the finish line, it's the starting line. When your dividend portfolio generates 75% of your expenses, you've proven that dividend independence is achievable. You've built the knowledge, discipline, and systems required for true financial freedom. The remaining 25% often accelerates rapidly because you're no longer building from zero. Your dividend income compounds alongside your continued contributions, creating exponential growth in the final stages. More importantly, you've gained something invaluable: optionality. You can choose how to spend your time based on fulfillment rather than financial necessity. You can take entrepreneurial risks without risking your survival. You can optimize for long-term value creation instead of short-term income generation. This is why the magic number matters so much. It's not about the money itself. It's about the freedom to align your actions with your values instead of your bills. The path to joining the successful 3% isn't secret or complicated. It requires mathematical clarity about your target, strategic optimization of your contribution capacity, intelligent portfolio construction focused on dividend growth, and psychological commitment to maintaining urgency throughout the accumulation phase. Most importantly, it requires understanding that dividend investing isn't about building wealth slowly and safely. It's about building income-generating assets aggressively and strategically. The investors who reach the magic number treat their dividend portfolio like a business designed to replace their primary income, not like a retirement account designed to supplement their pension. If you're serious about reaching that magic 75% threshold and joining the successful 3% of dividend investors, you need to understand the specific milestones that guarantee you're on track. I've created a complete breakdown of the 3 critical checkpoints that separate successful dividend investors from the ones who never make it. Check it out at right here. It's the perfect next step after understanding the magic number, because it shows you exactly how to measure your progress and course correct if you're falling behind.